Buy-to-let investors snapping up properties, rising house prices, and first-time buyers being pushed out the market. Has the UK's love affair with buy-to-let property really caused the housing crisis we're in right now? Or is it just an easy scapegoat for politicians to hide deeper problems they caused? Today, we're uncovering the truth behind the numbers, the policies, and the hidden forces shaping our housing market today. You'll be shocked to learn how much buy-to-let has influenced the homes we live in and what it means for the future. And in case you're wondering why the hell you should listen to me, well, I've spent since 2013 building a UK-wide home buying company, British Home Buyers, a nationwide estate agency, British Home Sellers, that has dealt with over 13,000 transactions, totaling about £3.3 billion of property. And although I hate to say it, there are 5 core evidence-based reasons why buy-to-let hasn't exactly helped with the housing crisis. And we'll conclude with the reasons it isn't the sole culprit, that governments are also to blame in all of this. So let's start with, in no particular order, reason 1, increased competition for housing stock. Let's start with one of the most obvious ways buy-to-let has influenced the housing market: increased competition for housing stock. Buy-to-let investors often target the same properties as first-time buyers. Smaller, more affordable homes like flats and terraced houses. These properties are typically the entry point into the housing market for many young people and lower income families. But instead of these homes being sold to people who want to live in them, they're being snapped up by investors looking to rent them out, of course, for profit. Now, here's where it gets interesting. According to this report by Nigel Springings of University of Glasgow, which I'll reference through this video, buy-to-let activity surged in the mid-2000s by 2006 dramatically. Buy-to-let mortgages made up nearly 19% of all transactions in the housing market at one stage, and in some areas that number was much higher. For example, on new housing estates, developers reported that up to 60% of homes being sold were to investors, not residents. The obvious effect: first-time buyers, already stretched by rising prices, were forced to compete directly with investors who often had an advantage. Unlike first-time buyers who relied on limited salaries to secure mortgages, buy-to-let investors could borrow against expected rental income or use equity from existing properties to finance. This gave them more purchasing power and allowed them to outbid prospective homeowners, driving up prices in these segments even further. And the problem wasn't just affordability, it was availability. With buy-to-let investors snapping up such a large share of homes, fewer properties were left for sale to people who actually wanted to live in them. This created a vicious cycle: higher demand, reduced supply, and skyrocketing prices, especially for the very properties first-time buyers rely on to get on the housing ladder to begin with. One thing that is worth adding is by 2007, it was actually about 25 to 40% cheaper to rent a home than to service a mortgage, as many households were priced out of the housing market by a combination of record house prices and subdued wage growth. Just take a look at this graph. This shows average weekly pay against average rent in the UK since the year 2000. Just see how average rent and average real earnings stopped running in tandem. Between the year 2000 and 2008, the outstanding buy-to-let mortgage stock increased from £9 billion to £140 billion, about 12% of the overall mortgage market. Now, buy-to-let mortgages issued equates to about 12.8% of the market, and the current outstanding mortgage debt now totals around £300 billion, equivalent to about 18% of the overall mortgage market. Reason 2, distortion of housing supply. Another critical way buy-to-let has impacted the housing market is through the distortion of housing supply, essentially changing how homes are built and who they're built for. The report highlights that as buy-to-let investment surged, it fundamentally reshaped the priorities of developers. Traditionally, the focus had been on building family homes, houses with 3 or more bedrooms that people wanted to buy and live in long term. But with the rise of buy-to-let investors, the market demand shifted. Investors preferred smaller, high-density properties like flats, which were cheaper to buy, easier to rent out, and required less maintenance. The numbers in the report make the trend impossible to ignore. Nationally, flats as a percentage of new builds skyrocketed from just 12% in 1997 to 40% in 2005. In London, the shift was even more dramatic. By 2005, 85% of new builds in the capital were flats, compared to 68% in 1997. The construction of larger, family-sized homes dropped significantly. In fact, 3 and 4 bedroom houses fell from 30% of new builds in 1997 to just 13% by 2005. This wasn't just a national phenomenon. It also played out at a regional level as well. For example, in Leeds, the share of flats among new builds increased from 14% in 2000 to 74% in 2006, completely transforming the local housing supply we now have today. So why did this happen? Developers responded to the immediate demand created by buy-to-let investors. These investors often pre-purchased units off plan before they were even built, giving developers a guaranteed cash flow. This encouraged developers to design future projects, not with homeowners in mind, but with investors in mind. As a result, high-rise apartment blocks, particularly in urban centres, dominated new developments, while family homes became increasingly scarce. The report also points out that government policies inadvertently fueled this shift. For example, planning rules emphasised building on brownfield sites and promoted higher density housing to conserve land. While these policies had good intentions, they aligned perfectly with what buy-to-let investors wanted: compact, easy to rent properties in city centres. Unfortunately, this left families and owner-occupiers with fewer options in the housing market. The result? A complete mismatch between housing supply and actual household needs. By prioritising small flats for short-term rental income, the housing market overlooked the growing demand for family homes. This didn't just limit options for buyers, it also drove up competition and prices in the resale market for those valuable family-sized homes, making it harder for owner-occupiers to find suitable housing. And here's the kicker. This trend hasn't solved the housing crisis. While new flats flooded the market, the overall supply of homes remained low, as new builds only account for about 1% of total housing stock annually. The focus on investor-fueled properties essentially didn't add properly. It diverted resources away from addressing the deeper issue here, a chronic undersupply of homes that people actually want to live in, those family homes. So while buy-to-let investors, of course, didn't directly dictate what developers built, their overwhelming influence on demand pushed the housing market in a direction that benefited investors, but not necessarily people who needed homes to live in. Reason 3, disconnect between house prices and incomes. Another way buy-to-let has significantly impacted the housing market is by contributing to the disconnect between house prices and household incomes. Traditionally, house prices were closely tied to what people in a local area could afford based on their wages. But speculative buy-to-let investment has broken that connection. The report reveals how this happened. As buy-to-let investors entered the market in large numbers, they didn't base their purchasing decisions on affordability or income. They were focusing on expected rental returns and capital appreciation instead. This fundamentally changed the way demand worked in the housing market. Instead of prices reflecting what local buyers could afford, they started reflecting what investors were willing to pay instead. The data is striking. Between 2000 and 2006, house prices at the lower end of the market, where most first-time buyers operate, soared. The ratio of the lowest quartile house prices to income rose from 4 times in 2000 to 7.1 times in 2006. That means a house that cost 4 times the average lower income salary at the start of the millennium would 6 years later cost over 7 times as much, far outpacing wage growth. In certain areas, the disconnect was even more severe. In London, for example, the income to house price ratio for lower income households rose from 5.6 times in 2000 to an astonishing 8.6 times by 2006. This meant that even households earning at the lower quartile of London's wages had almost no hope of affording a home. But how did buy-to-let drive this? Unlike first-time buyers who are restricted by their income when borrowing, buy-to-let investors could rely on projected rental income or equity from other properties to secure their loans. This gave them an advantage in bidding wars, allowing them to offer more than what local buyers could afford. As demand from investors increased, prices were pushed higher and higher and higher, breaking that natural link between local earnings and house prices. As you can see from this graph I showed earlier, the disconnect between average earnings and rent is mind-blowing. And you can see here how average house prices against average salary has been skyrocketing from one another for decades. This disconnect between house prices and incomes isn't just an economic issue, it's a structural one. The traditional assumption that housing markets are driven by local household demand no longer holds true. Instead, speculative investment has become the dominant force, reshaping the market and leaving many aspiring homeowners behind. Reason 4, market volatility and lending practices. Another major way buy-to-let has impacted the housing crisis is through market volatility and risky lending practices. The rise of buy-to-let wasn't just about investors buying properties. It was also driven by banks and lenders creating new financial products to fuel this investment boom. But as the report highlights, these risky practices ultimately destabilized the market and contributed to the housing bubble. So let's start with the numbers. The report shows that from 2001 to 2007, lending for buy-to-let mortgages skyrocketed, increasing from 6.9 billion to 45.3 billion pounds. By 2006, buy-to-let mortgages accounted for nearly 19% of all transactions, and a significant proportion of these loans were based on speculative expectations of rising house prices and rental income, rather than the actual value of the properties at the time. Here's where the problem gets bigger. Many lenders weren't concerned about the long-term stability of these loans. Instead, they encouraged over-leveraging, allowing buy-to-let investors to borrow large sums, often with minimal deposits. Some loans even relied on inflated property valuations, under the assumption that house prices would continue to rise indefinitely. As the report points out, this behaviour wasn't isolated, it was systemic. In fact, the Financial Times highlighted how lenders often didn't care about accurate valuations during the housing boom, because even if a property was a bit overvalued right now, its price would catch up in a few months' time. This risky lending wasn't just irresponsible, it was inflationary. It pumped more money into the housing market, artificially driving up prices that we're still living with today. And while buy-to-let investors benefited from this short-term boom, the market became increasingly fragile. When house prices stopped rising, cracks in the system became apparent. A clear example of this fragility came with the Northern Rock crisis in 2007. Northern Rock had aggressively expanded into buy-to-let and other high-risk lending markets, relying on wholesale funding to fuel its mortgage business. When the global financial crisis hit, this business model collapsed. The subsequent credit crunch led to a rapid withdrawal of buy-to-let mortgage products, leaving many investors unable to refinance their loans and exposing the speculative bubble that had formed. And the consequences weren't limited to investors. As the report highlights, this speculative behaviour distorted the entire housing market, leaving it more vulnerable to economic shocks. First-time buyers and owner-occupiers already struggling with higher prices were further impacted by a tightening of lending criteria. Lenders shifted from encouraging risky loans to restricting credit, causing house prices to stagnate or fall in investor-heavy markets. Ultimately, the risky lending practices that fueled the buy-to-let boom didn't just inflate house prices, they destabilized the entire housing market. What started as an opportunity for investors to generate rental income spiraled into a speculative bubble, creating volatility that has had long-term consequences for homeowners, renters, and the broader economy. The final reason 5, is erosion of home ownership. So finally, let's talk about how the buy-to-let market contributed to the erosion of home ownership. For decades, home ownership in the UK had been steadily rising, seen as a cornerstone of financial security and long-term wealth for households. But the surge in buy-to-let activity reversed this trend for the first time in over a century. The report reveals that buy-to-let investors began acquiring properties at a scale that far outpaced the rate of new housing supply. In 2003 onwards, the number of buy-to-let purchases significantly exceeded the volume of new homes being built. This meant that rather than adding to the overall housing stock, buy-to-let investors were simply transferring ownership of existing homes from what would be homeowners to landlords. The data is telling. By 2006, buy-to-let mortgages accounted for nearly 20% of all housing transactions, a figure much higher in certain areas and market segments. In many cases, these purchases were concentrated in lower value properties, exactly the kind of homes that first-time buyers would typically aim for. This created a bottleneck as fewer properties were available for purchase by owner-occupiers. The result? A complete decline in home ownership rates, particularly among younger households. According to the report, many first-time buyers were completely priced out of the market and forced into the private rental sector, where they often ended up renting homes that had been bought by buy-to-let investors. This dynamic fundamentally changed the makeup of the UK housing market. Rather than a nation of homeowners, the UK began shifting towards a model where renting became the default for many people, particularly younger generations. And it's not just about individual households. The decline in home ownership has broader societal consequences, as the report points out. One of the reasons successive governments promoted home ownership was that it provided financial security in retirement. For example, older homeowners could downsize and use the equity from their homes to fund their care. But now, with fewer people able to buy homes, there's growing concern that more people will face financial insecurity as they age, potentially placing a greater burden on the state. What's even more troubling is that buy-to-let investors didn't just compete with homeowners, they also reshaped the market by purchasing homes that could have been sold to owner-occupiers. Buy-to-let landlords effectively funneled a large proportion of the housing stock into the private rental sector. This not only reduced the supply of owner-occupied homes, but also increased the demand for rental properties at the same time, driving up rents in the process. In summary, the rise of buy-to-let didn't just create more landlords, it reduced opportunities for people to own their own homes. This erosion of home ownership has had lasting consequences we're living with today, from pricing out younger generations to increasing reliance on the private rental sector. And while buy-to-let investors have profited from rising prices and rental income, many aspiring homeowners have, of course, been left behind in the process. So in conclusion, while buy-to-let landlords are not the sole culprit to the housing crisis, it has significantly amplified issues in the housing market. And look, I'm a landlord, so, I'm not against it, but, it has increased competition for affordable homes. It has distorted housing supply towards investor preferences. It has disconnected house prices from incomes. It has fueled speculative bubbles through risk lending by banks. And it, of course, has eroded home ownership rates. But rather than just blaming us landlords, let's briefly rattle through 6 evidence-based reasons governments of the last 50 or so years are also to blame, because after all, don't they set the rules of the game we're all playing? Reason 1, insufficient housing supply. For decades, successive governments have controlled housing targets and the mechanisms to meet them, and they've consistently failed. Since the 1970s, UK housing completions have plummeted, with councils no longer building significant numbers of homes and private developers unable to fill that gap. Government set the rules, but they allowed public housing construction to collapse, relied too heavily on the private sector, and never implemented policies to address the growing shortfall. This chronic undersupply of housing, entirely under government oversight, has fueled the crisis, and demand continues to outstrip supply year after year. Reason 2, planning and regulatory constraints. Planning rules dictated by the government are a major bottleneck in housing development. Policies designed to protect greenbelt land and prioritise brownfield development may have good intentions, but they drastically reduce the availability of land for new homes. Governments also control the planning process, which is notoriously slow, bureaucratic, and influenced by local opposition. By failing to reform planning laws or streamline approvals, successive administrations have made it far harder to deliver the affordable family homes that people need, particularly in high demand areas. Reason 3, financial deregulation and risky lending practices. The government has ultimate authority over financial regulations, and its decisions to deregulate the mortgage market in the 1980s and beyond created a foundation for reckless lending. By relaxing controls on banks and building societies, they allowed risky mortgage products to flourish, like high loan-to-value and interest-only mortgages. This fueled speculative bubbles, inflated house prices, and destabilised the market, as seen during the 2008 financial crisis. The policies that allowed this free market approach to housing finance weren't accidents. They were government decisions. Reason 4, income inequality and wage stagnation. Governments have also overseen policies that directly affect wages and income distribution. While house prices have surged, wage growth has stagnated for decades due to policies that didn't prioritise raising incomes, improving job security, or tackling inequality. Tax and welfare reforms often favoured wealthier homeowners and landlords while leaving renters and lower income households behind. The disconnect between wages and house prices was entirely predictable, and governments failed to intervene to bridge that gap. Reason 5, urbanisation and regional disparities. Governments control infrastructure spending, regional investment, and economic policy, obviously, all of which have exacerbated regional housing imbalances. For decades, administrations have prioritised London and the South East, pouring money into these areas while neglecting others. This has driven urban migration, pushing demand for housing in cities far beyond supply, while leaving homes in less desirable regions completely underutilised. This lack of cohesive nationwide housing strategy to address these disparities has concentrated the crisis in high demand areas. And the final reason, number 6, global investment in UK housing. Governments have actively encouraged foreign investment in UK housing by creating policies that make the market so attractive to overseas buyers. Tax incentives, lax regulations on international property purchases, and a lack of restrictions on empty properties have turned the UK housing market into a global safe haven for investors. While this might generate short-term revenue, it has come at the cost of reducing housing affordability for local residents, especially in London. The government has been fully in control of these policies, yet it has failed to safeguard housing for the people who need it most. So in conclusion, what do you think? Do you think the government's doing a good job? Is there anything I've missed? Please like and subscribe because it helps my videos reach more people. And if you want to see more of me, I'll see you in the next video up here.